Hello traders, Gary Wagner here, just after 1 o'clock in Honolulu, 7 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands, June 22nd, 2018, and this is the Daily Report for Gold and Silver, our weekend review, and what a week we have seen. Now for the second consecutive week, we do have gold closing at a low. That is the lowest closing price of 2018. Gold did close higher today, but nominally up about 60 cents at $12.7110. Nice move in silver, though, up 12 cents at $16.45, and that was all with the tailwinds of a lower U.S. dollar, down 21 points at 94.18. Dow Jones Industrial Average did score a positive gain above about 119 points, closing at 24,580, and Bitcoin futures fell out of bed, losing almost $700 as it traded to $6,030 on our futures exchange. Traders, no doubt, this has been a tough week for gold, now for the second consecutive week, closing at lower pricing. We can see that on this weekly candlestick chart, in which the market lost approximately $11 as it opened at $12.81 and then closed today at about $12.7110. The 60-cent gain was muted by activity throughout the week. And we can certainly see the damage that was done when we look at our daily candlestick chart. Of course, it was nothing like what we saw last week when on one single day, Friday's close, in which gold closed about $26 lower. Nonetheless, this week started with a slow and methodical climb to lower pricing. Then yesterday, we hit the lowest trading point of the year when intraday gold traded as low as $12.61, crossing below the 0.78% retracement level. However, it did close just above that, and then today gained slightly, as I said, up about 60 cents. However, there are a couple of alarming factors that we need to look at. One of the most concerning aspects of this week's trading is the fact that there is a high probability at this point that we will see gold go into what's called a death cross. Of course, a death cross is when the shorter term 50-day moving average crosses below the 200-day moving average. The 200-day moving average has definitely been below the 50-day moving average throughout this entire year, and it would mark the first occurrence of a death cross in gold in about 2 years. At the same time, we have to acknowledge that after hitting the lowest trading point this year, when yesterday the market went to $12.62, we did get a slight recovery and, most importantly, crossed back above the 0.78% retracement line at $12.67, opened above it today and closed above it today. Moving averages are a lagging indicator, and therefore they will never account for current market moves. Nonetheless, it is something that we need to keep a close eye on, because further selling next week would definitely complete this pattern, in which we would see the shorter term 50-day moving average actually cross below the 200-day moving average. And traders, the reason a death cross in gold could be such a foreboding technical indicator is take a look at the last occurrence of that, which happened in November of 2016, when gold broke from approximately $12.81 and traded $150 lower, with that correction not concluding until prices reached $1,120. Traders, this current sell-off has been driven by dollar strength, because what we have seen is when gold hit its apex of the year, the highest trading point back around mid-April, was when the dollar had bottomed at around 89. And more interestingly, what we are noticing right now is not only the potential for a death cross in gold, but when we look at our daily dollar chart with the same indicators, a 50 and 200-day moving average, what we see is the occurrence of a golden cross. That is the point in time in which the short-term moving averages move back above the longer-term 200-day moving averages, which can signal the point in time in which a shorter-term bullish trend moves into a long-term bullish trend. At the same time, we must acknowledge the dollar, which hit an intraday high this week of 95, is at a current level of fairly substantial resistance. At the same time, when we look at our gold chart, the 0.78% retracement level is still an acceptable level in which we can see a correction occur and a subsequent rally follow. Traders, the key to the future direction of gold lies squarely on the shoulder of the dollar, and whether or not this resistance area will hold. The key to that is whether or not the fundamentals at play that have been moving the dollar higher and gold lower remain in market sentiment. Traders, as we've spoken about throughout the last couple of weeks, the key to gold's future is dollar strength or dollar weakness. Right now, we have seen extreme strength in the dollar, and that's based upon some fairly strong fundamental factors moving the dollar higher. The key is this: if the dollar continues to move higher, we will see continued pressure on gold. We need to see a reversal in the dollar before we're going to see any kind of bottom action forming in gold. The only thing that can bring about that is a weakening U.S. economy or the current dispute between China and the United States turning into a full-blown trade war and the implementation of more tariffs. We'll have to see how this unfolds. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you next week for another daily update and review. Bye-bye.